Welcome to Moneycontrol. Today we are going to talk about IDBI Bank. The divestment of IDBI Bank has created a lot of buzz and government has received multiple bids. The names of several domestic and foreign institutions are doing the rounds for having submitted expression of interest to acquire 61% stake in IDBI Bank from government and LIC. The interest in IDBI Bank isn't surprising, given that IDBI Bank has a large and a strong deposit franchise and also has a widely spread branch network. Moreover, the bank has significantly strengthened its balance sheet and has improved its profitability over the past few years. IDBI Bank's profitability in FY21 and FY22 was mainly supported by lower credit cost, recovery from the return of accounts and tax refund. However, the encouraging bit is that in the last reported quarter, that is Q3 FY23, IDBI Bank's profitability was mainly driven by healthy growth in advances and expansion in margins. Now, talking about the funding profile, the funding strength of IDBI Bank gets reflected in the high CASA ratio, which stood at around 54% as of December end. There also has been a notable progress in garnering the retail deposits, and the share of bulk deposits has significantly reduced over the past few years. Talking about the advances book, the bank has reduced its corporate exposure and has been mainly doing retail lending. The share of retail advances has increased to 67% of the total advances book as of December end and has improved from 51% in March 19. Talking about the most important thing, that is asset quality of the bank, that has significantly improved. Gross and net NPA ratio have trended better and slippages have been contained. The overall riskiness of the portfolio has significantly reduced and gets reflected in the restructured book, which is contained at around 2.3% of the advances book. The special mention accounts, which are indicator of early stress in the book, has also reduced to around 1.2% of the total advances as of December end from 2.5% of the total advances as of March 21. So overall, the bank's riskiness of the portfolio has reduced, but the most encouraging bit is that the bank has significantly improved its provision coverage ratio, which is almost at around 98% currently. The bank has fully provided for its legacy stressed accounts. So overall, the bank's performance has significantly improved, but the key question worth asking is that how much will the potential buyer will be willing to pay for IDBI Bank? If we look at the current market price, the bank is trading at around 1.3 times the book value estimated for FY24. The current valuation is reasonable considering that return ratios has significantly improved. Return on asset has inched above 1% and return on equity is around 15% for the first 9 months of FY23. That said, the valuation of the bank will be mostly driven by the impending divestment deal. Given the current market capitalization to deposit ratio and going by the historical deals in the banking space, IDBI Bank's divestment can fetch much more than its current market capitalization. However, since the stock upside is contingent on the deal, any delay can be a risk. Nevertheless, long-term investors with a time horizon of more than 1.5 years can keep the stock on their radar.